welcome to this webinar, which is dedicated to risk modeling and its role in designing strategies to increase financial resilience. This is the third episode of the SCORE webinar series that are organized every 2 months as part of our outreach activities to present the work done within the different work packages. And the next webinar is planned to take place in May, but we will have a precise date in the following weeks. So before starting, I inform you that the webinar is recorded and it will be made available in the next days in the SCORE YouTube channel. So my name is Laura Denale. I am from Euronovia. We are the partner responsible for communication and dissemination for the SCORE project, and that I will briefly present you in a few minutes. But before that, I show you the agenda for today. So we have two speakers. The first one is our colleague Rui from RED, which is one of the partners of the SCORE project. RED is a company based in Italy with a strong experience in developing disaster risk assessment models and loss estimation of natural disasters and climate-related perils. Our colleagues from RED are also the co-organizers of this webinar. So Rui will present us the importance of quantitative risk models in the design of financial resilience strategies. And our second speaker is a guest speaker, Dario Lunapla from Aqua Capital, which is a private advisory firm focused in the insurance and reinsurance sectors of Latin America. And he's joining us from Canada today. So thank you very much for being here and having accepted our invitation. And Dario is going to present us some implementation cases of risk financing strategies. After these two presentations, we will have a Q&A session. So for that, we invite you to write down your questions in the Q&A tab that you have here on Teams. And you can write your questions whenever you want during the webinar, but we will answer them only at the end of the webinar in the last 20 minutes. And one last point before starting the webinar is that I would like to invite you to open the slido.com website and to enter the code you see here in this slide. So that you'll be able to join the session and answer live the short questions we have prepared for you. So please join the Slido now. And in the meantime, I take the opportunity to remind you that this webinar is organized in the framework of SCORE, which is a European Horizon 2020 project led by the Atlantic Technological University of Sligo in Ireland. So SCORE stands for Smart Control of the Climate Resilience in European Coastal Cities, and its main objective is to design, develop, and validate robust adaptation measures in coastal and low-lying areas to protect them from increasing climate and sea level risks, including coastal flooding and erosion, and to enhance also their overall long-term resilience. So if you're interested to know more about our activities and the next events, I invite you to visit our website and follow us on social media. We have a LinkedIn and Twitter account and also account on Facebook and Instagram. So now before I give the floor to Rui, we have just a few questions for you so that we get to know you better. We would like to know which country you are from. So you can type on Slido if you have opened it. Okay, so most of you are from Italy, Portugal, and Ireland, but we have a representation of different countries, so that is very good. Also, somebody from Turkey and Peru. That's nice. And one last questions, if you have already joined the SCORE webinar before, because this is the third one. Okay, great. So half and a half. Yes, perfectly a half and a half. Great. So we invite you to check our website also for next events because we will announce soon the date for the of the fourth SCORE webinar. Thank you very much. So now, Rui, the floor is yours.
Thank you. Let me share my screen. Okay. So thank you, Lara, for the introduction. I'd like to start by thanking the audience with us today. I hope you enjoy this webinar. My name is Rui Figueiredo. I'm a civil engineer, catastrophe risk modeler with a PhD in understanding and managing extremes. Over the years, I've had the opportunity of participating in various projects related with disaster risk assessment and management. And today, in the context of the SCORE project, I will be talking a bit about quantitative risk models and their importance in the design of financial resilience strategies. So before getting started with the actual presentation, so also to engage a bit with you, since we all have this Slido poll open, I'd like to invite you to answer this question with whatever comes to your mind in a couple of words. What action would you put in place to address natural risks in a coastal city? So don't think too much, just whatever pops up on your mind. Yeah. Okay. Have some people typing. Okay, it's interesting. We have some heterogeneity in the type of actions that we are seeing here, from more structural measures based on ecosystem-based approaches like sand dunes, natural vegetation, and also non-structural measures like awareness raising, alert systems, and also insurance. So that's quite interesting and reflects quite well different tools that exist in the risk management toolkit. Yeah, so thank you very much for yeah, okay, very interesting. So thanks for your inputs. So now we will see the presentation where, of course, we will give a bit more emphasis to the risk financing part, which is, after all, one of the topics of this webinar. So, disaster risk management. In recent decades, there's been an increase in population and assets exposed to natural hazards, particularly hydrometeorological phenomena. And this trend is expected to continue into the 21st century due to ongoing socioeconomic transformations and environmental transformations, including the effects of climate change. And as a result, we have seen in recent years growing worldwide attention towards the management and reduction of catastrophe risk. And this is emphasized by various worldwide initiatives, such as the well-known Sendai Framework for Disaster Risk Reduction, which was adopted by all UN member states in 2015. At the European level, and specifically for the flood hazards, we have seen the implementation of the European Directive on the assessment and management of flood risks. And so the Sendai framework aims both to reduce disaster risk, but also to increase preparedness for response and recovery, strengthening resilience, including financial resilience. And to achieve this goal, the first priority of the framework is that disaster risk management needs to be based on an understanding of disaster risk in all its dimensions of vulnerability, capacity, exposure of persons and assets, hazard characteristics, and the environment. So therefore, understanding disaster risk is at the core of risk management decision-making. And this needs to be supported by quantitative risk assessments in order to be performed in a rational and knowledge-based manner. Of course, another key component of disaster risk management is financial protection against disasters, which is also highlighted by the Sendai framework. Financial protection is also identified as one of the pillars of the disaster risk management framework by the Global Facility for Disaster Risk Reduction, as shown on this slide. These 5 pillars, risk identification, reduction, financial protection, preparedness, and resilient recovery, are associated with different steps of a continuous disaster risk management cycle, where first and foremost, it's critical to assess the risks to which a country, or of course in the context of SCORE, a CCLL, a coastal city living lab, is exposed. Based on this knowledge, financial protection can be built by developing and implementing a robust and well-designed risk financing strategy. So financial protection is critical in managing the financial shocks that occur after disasters. And so it's a necessary step to improve financial resilience to extreme events. So it's a non-structural measure that complements risk reduction and risk mitigation actions by helping governments, national or subnational, to address risks that are not feasible or cost-effective to mitigate. So before proceeding, it's important in the context of quantitative risk modeling to provide a more formal definition of what risk actually is. So risk is the probability that certain impacts or losses will occur, function of 3 components: hazard, exposure, and vulnerability, where the hazard describes the frequency and intensity of a given peril, for example, floods. Exposure describes the spatial distribution, characteristics, and replacement values of assets at risk. And vulnerability describes relationships between hazard intensity and potential impacts, such as economic losses. This conceptual flowchart illustrates how these 3 components come together to model risk. I will briefly go over each of the 3 components in the following slides. So here, what I'd like to highlight is the key output of quantitative risk assessments, which is the annual loss exceedance probability curve, seen here on the bottom right. This curve, commonly known as risk curve, provides probabilistic information on the likelihood that a loss equal to or greater than a certain amount will occur in any given year. And so it's the basis for developing actions such as cost-benefit analysis of risk mitigation measures and, for example, pricing of risk financing instruments. Let's now then have a look at each of the risk model components, starting by hazard models. Perhaps the most well-known outputs of hazard models are hazard maps, which describe areas exposed to a certain hazard intensity for different return periods. And this hazard intensity could be, for example, in the case of floods, water depth for different return periods. And from a loss assessment perspective, hazard maps can be useful for providing probabilistic representation of hazard intensities, and which of course can subsequently be used also for loss estimation at local levels, and for computing impact metrics such as average annual losses. However, hazard maps lack information on the spatial correlation of event occurrence, which is something that's quite important when talking about hazard modeling. So, for example, here we see the European 100-year return period flood hazard maps, fluvial flood hazard maps. And yeah, in order to obtain a fully probabilistic representation of hazard and risk in large areas, such as here the European Union or Europe, it's necessary to take into account the likelihood of having simultaneous events in different parts of the territory. So this map doesn't mean that a flood will occur covering all this extent all at once at the same time once in 100 years. So it's important to have a model that is able to capture the probability of the events occurring simultaneously in different parts of the territory. And why is this relevant? Because if we don't have this information, if we hypothetically consider full correlation between event occurrence, we would be overestimating the tail of the loss exceedance probability curve, whereas if we consider no correlation at all, we would probably be underestimating the tail of the risk curve. And so, of course, here, if we have a realistic representation of spatial correlation, probably our curve would be somewhere in between. And this is quite relevant because we need to have an accurate representation of risk in order to take informed and robust risk management actions. So to achieve this, to capture the spatial correlation, one needs to have a model based on which we can develop a stochastic event catalog, which is a large data set of synthetically generated flood events, in this case, that are consistent with historical ones. Of course, for the score CCLLs, given their relatively small size of the study areas, the flood risk curve that we will need to develop further ahead in the project can probably be approximated based on flood hazard maps, of course, provided that they are developed for a sufficiently large number of different return periods. Okay, now continuing to the exposure component. Exposure refers to the elements that are present in hazard-prone areas and are therefore at risk of suffering losses. So they are the elements themselves. The exposure model is a geospatial database that describes the location, replacement values, and the characteristics of those elements. So those characteristics could be, for example, in the case of buildings, building materials, construction date, presence of basements. So properties of the assets at risk that are relevant to then characterize their vulnerability to a given asset. In terms of collecting data for building an exposure model, at local scales, it would be pretty straightforward to make in situ collection of anything we need to collect to develop the model. However, even in medium-sized cities, and here this picture is of Villanova, one of the CCLLs of the SCORE project. Of course, this becomes impracticable. So something else needs to be done. It cannot be based on a building by building surveying, for example. So to tackle this challenge, exposure modeling typically involves combining multiple sources of information. As an example, for buildings, the most important and reliable source of information is national census datasets. However, census data is usually only available at relatively coarse resolutions, not on a spatially explicit building by building level, for example. On the other hand, recent years have seen a considerable increase in the availability of open data from other sources, particularly for buildings and infrastructure, and these are often available at the object level, but of course they tend to have a limited amount of information. So the idea and the state of the art in exposure modeling typically consists in merging different sources of information, for example, in the case of buildings from some census and from building vector data, obtained, for example, from OpenStreetMap to generate a gridded exposure model. So each of these data sources are insufficient on their own, but can be combined using appropriate modeling techniques and to generate typically a geospatial gridded exposure data set. So data on a spatial grid as seen here in this conceptual scheme. Finally, regarding vulnerability, a vulnerability model then, as I already mentioned, is the relation between one or more hazard intensity measures and the corresponding damage or loss. For floods, the most typical and most commonly used vulnerability model is the so-called depth damage function, which for a certain type of assets establishes a relation between water depth at that location and expected damage. So there are two main quantitative vulnerability modeling approaches. These are the names that are used in the flood scientific field. Empirical functions are constructed using collected damage and loss data from previous flood events and fitting a model to those data points. And an example of this type of function is the one seen here on the left. Whereas, these data are often not easy to collect, not always available, not always collected in a consistent way. So it's often quite a challenge to develop purely empirically based flood vulnerability models. So an alternative approach or complementary could be is synthetic one, where functions, vulnerability functions are constructed using expert knowledge, engineering knowledge, and what-if analysis. So just to give a very quick example of this, this is the model that we are using to model the flood vulnerability of buildings within the SCORE project. It's called INSIDE, Synthetic Probabilistic Flood Damage Model, based on explicit cost analysis. And how this works is that based on engineering judgment and other sources of information like technical reports and construction costs, repair costs, etc. The building is subdivided into different components. Damage and losses are estimated for each component individually. And then these are combined to obtain a final vulnerability function that can be used within a flood risk model. So having introduced the three building blocks of a risk model, and also what a loss exceedance probability curve is, let us now look at risk in the context of SCORE. So here, the so-called baseline risk is defined as the estimated initial risk before the implementation of ecosystem-based approaches for hazard mitigation, whereas residual risk is defined as a risk that remains after the implementation of such measures, which are being studied, and this is one of the components of the SCORE project. So each of these risks, both the baseline risk and the residual risk, are associated with a different loss exceedance probability curve, as shown here on the right, where the difference between the two curves would represent the economic benefit from the implementation of ecosystem-based approaches. And this is one of the type of information that can be used to support cost-benefit analysis for the development and implementation of these measures. So of course, there's a residual risk that cannot be mitigated through EBAs, either because it's not feasible or not cost effective. And that residual risk also needs to be dealt with. And this can be done through risk financing. So here, risk assessments allow estimating the losses, as we saw, and therefore the financing needs associated with residual risk. And to tackle these financing needs, multiple risk financing instruments exist, which vary in cost, disbursement time, which is the time delay between the event occurrence and when the money is actually received, and the availability of funds. Risk transfer instruments, such as the ones shown here on the right, for example, insurance, reinsurance, or insurance-linked securities, are best suited for low frequency, high severity events occurring, for which high liquidity is necessary. In the case of more frequent events, paying a premium to cover these costs would be inefficient, and other risk financing instruments such as contingent credit or budget reserves should be used. However, these also come with their own limitations. So a comprehensive disaster risk financing strategies typically should utilize different risk financing instruments complementary among them for different types of risks. So catastrophic risk layering, it's the name of this, no? Like using different instruments for different layers of risk can be used to design a risk financing strategy. And the definition of the level of fiscal resilience and the most adequate risk financing strategies should be taken based on various socio-economic considerations. And of course, risk assessments are part of the tools that can support the definition of the optimal risk financing strategy, for example, for a coastal city living lab. So that's my presentation. Thank you very much.
Thank you, Rui. So just a reminder to all participants, if you have any questions, you can write your questions in the Q&A tab on Teams here that you can see the menu, and we will answer them at the end. So now I leave the floor to Dario.
Thank you.
Please share your screen.
Thank you for having me here today. I will share my screen now. Second. So I'm Dario Luna, managing partner of Aqua Capital, an small advisory firm in Mexico. We've been working with engineering firms and governments and insurance schemes around, mostly around Latin America, but other parts as well, into trying to solve this problem about the funding or the financing that Rui was very well explaining a minute ago. So what I'm going to do today is spend some minutes on presenting you the menu and the tool set that policymakers have around this problem and some of the ways that it has been solved and what's the rationale for solving it. So, well, the first thing I would like to say is just picking up on the value of quantitative models. Why are they so relevant to formulate risk management strategies? They're not obviously they're not the only way of doing it, but I think in the last 20 years, they've proven to be probably the most accurate way of estimating the potential impacts of natural disasters, including their likelihood of occurring, the estimation of damage, and the economic and social costs associated with emergency relief and reconstruction. They are also valuable because they can identify areas that are particularly vulnerable to natural disasters. The approach to modeling risk in this hazard, exposure, vulnerability, or approach is very flexible. It's very powerful. Engineers and CAD modelers use it to really zoom in the parts that are most vulnerable and most likely to suffer an impact from natural disasters. And this is both for population and the economy in general. But you know, for some time I spent in Mexico helping in the Ministry of Finance, helping to develop the risk management strategy nationwide. And I really relate to this third point on the value of quantitative models. They help policymakers better understand the costs and benefits of different disaster risk management strategies. Rui was touching upon this point in the last few slides of his presentation, on how by understanding the change in risk that a particular government, city, agent is facing before and after implementing some risk mitigation measure, either structural or not, or by comparing the funding alternatives, you can really nail down what are the costs, what are the benefits, and what's the best approach going forward. And then you can actually include a time frame on it, and depending on the mandate that many policymakers have around what their main responsibilities. So they are very powerful, and as I said before, they've been increasingly being used in the last 20 years to solve this problem. So what is the financial policymaker toolset? And I see that in this field, we like colorful boxes. I'm sorry if you get confused with this, but I'm borrowing this from UNICEF, which is, and you would think that they are indirectly trying to solve the funding problem because they have more pressing issues up front. But they presented this menu of policymaker toolset for financing very eloquently. So I'm using it. So a comprehensive strategy would typically involve several of these policy tools and instruments. If you sort of look at the horizontal axis is just a division of time between when the event, the catastrophe, the natural event occurs. They call it a shock, before and after, right? So before you can prepare, and after you have to really deal with the issue. And then on the vertical axis, you have the frequency and severity of that shock, of that event, between high frequency, low severity, and low frequency, high severity. This resembles a little bit of Rui's loss exceedance curves that he was presenting, right? Where you would see that there's a trade-off between frequency and severity happening naturally reflected by the CAT models, but on reality out there in the world. So the tool set would involve strategies for risk retention and risk transfer. And retaining risk it can be done voluntarily on purpose as a strategy, or it must be done because there's nothing else to do. And some local governments or federal governments have that responsibility of last resort, of being able to help when things go really bad after a natural catastrophe. So in the risk retention layer, we have the budgetary instruments that we was talking about: reserve funds, contingency budgets, budget allocations, on an ex ante strategy. Ex post, governments will do what they have to do. They will do supplementary budgets. They will do budgetary reallocation. They will try to transfer funds from wherever they can to deal with the emergency. There's also lending instruments, contingent credit lines. These loans that trigger disbursements when a specified catastrophe happens. It can be an earthquake, it can be a tropical cyclone, a flood. And then obviously governments can just go out and borrow money. Some of them more easily than others, depending on the health of their public finances or their rules and regulations. And then for lower frequency, high severity events, as Rui was well explaining, you have risk transfer strategies. And this in purple is something that is probably not applicable to really emerging economies or lower income governments, where they don't have access to financial markets, and they have to do non-market risk transfers like humanitarian aid and so on. But for those governments that have access to the financial markets, you have market-based instruments in the capital markets like cat bonds and swaps and all, and then in the reinsurance and insurance markets through directly or through risk pools. So the key questions here is, okay, we have the tool set, we have the menu. How can policymakers build the best performing strategy? How do you mix these things? And again, their quantitative probabilistic models are extremely helpful in finding an answer. So what I'm going to do now is to give you a very simplistic step-by-step mini guide to formulating a financial strategy that mixes all these some of these tools. So we use the loss exceedance curves that Rui was presenting, those curves that result from a hazard model supporting an exposure model, supporting a vulnerability model, and describing risk in probabilistic terms for a particular hazard or group of hazards. And we use them to generate thousands and thousands of random economic scenarios, economic losses. Those economic benefit analysis that Rui was presenting, we can do it very powerfully with quantitative models to really get the distribution of gross losses and net losses. Gross losses would be the status quo, what it is currently happening without any form of mitigation of investment or any form of risk transfer or any absorption of those losses into any instrument. And then we compare that to the net losses, which would be the gross losses minus the loss reduction plus the cost of any instrument or mitigation that you use. And this is where cost-benefit analysis kicks in. And so we can play really with a model and ask questions on, okay, what is the benefit of introducing a structural measure, a sand dune, like, you know, it was being discussed earlier, or what is the gain in terms of risk reduction if we purchase an insurance policy. But in order to do that, we really need to model also the financial instruments or the instruments that are going to be used to fund the those losses or partially fund those losses. And there are three. I mean, this is an example of that we used before. But let's say you have you're considering as policymakers using a reserve fund, an insurance policy, and contingent debt. You will need to solve some things around these things to determine the cost of these things and the benefits. The first, in terms of the reserve fund, you will need a discount rate. That means if you're going to separate money, public money, into a fund and keep it there for a time until a low frequency, high severity event happens, there's an opportunity cost of that money. And you need to discount the future benefits of risk reduction with that discount rate. So this is typically a discount rate that is, I'm sure many people in the audience know about this sort of public investment discount rating that is a good measure of that opportunity costs. Then we have to include the insurance costs or the premiums, as we call it in the industry. So the quantitative model provides an actuarial price of insurance, which is the average annual loss. In that loss exceedance curve is the sort of the average of what can happen. But we must load it to account for the cost of capital that insurance companies have and operational expenses and so on. So we need a good, reasonable assumption of what the full cost of insurance will be. And then finally, in terms of contingent debt, these are loans that are offered by multilateral organizations or banks that include include these triggers where governments can disburse the loan upon the verification of an event happening, a predefined event, catastrophe, and there's a range of fees that apply whether it's been disbursed or not, and then there are terms on how, you know, the maturity of the loan and so on. So you have to use all these financial instruments to pick up the costs, right measure of the cost, so you can compare it to the benefits. And you can do this over time periods, not only on a yearly basis, but maybe you know, some policymakers would like to have a 5 or a 10-year period problem-solving scheme in which they base their financial strategy in order to secure or give certainty to the people and to the community and to their public finance, you know, on a longer time frame. So those are steps 1 and 2. And once you have that, then you can start comparing the performance, the relative performance of each of these instruments. And this is an example that could have gone, I mean, depending on the assumptions, it could have gone either way. So what you're looking at in this graph is the return period of the losses in terms of years on the horizontal axis, and the risk reduction in percentage terms on the vertical. So there will be strategies that not only not reduce risk, but they are also they have their costs exceed their benefits. So there's an increase actually in in risk by using this financial instrument. Whereas there's others that it is efficient, the benefits exceed the costs of using them, and so they effectively reduce the overall risk level. So in this example, we have in blue the performance of in terms of risk reduction of insurance for loss events that happen every 50, 100, 200, 500 years. Same thing for contingent debt, and lastly for this reserve fund. Funnily enough, in this example, the reserve fund might not be cost efficient because perhaps the discount rate was too high, and the government is better off spending that money on socially impactful programs that have a very high social return. Once you have that, then this is a really interesting exercise for policymakers on what is the risk tolerance and what does public policy tell us. There are some countries or some local authorities that have a very clear mandate on, okay, if there's a natural catastrophe, it becomes a disaster, what is our responsibility? Where do we draw the line? Do we have to spend money reconstructing large businesses and factories, or we only have a responsibility in reconstructing vulnerable people's homes or critical infrastructure? There's a mix here in terms of what the responsibility is, and this is a point of connection with the quantitative model as well. Remember the exposure model that Rui was explaining. Well, you can tailor-made that exposure. You can tailor that exposure model component to the explicit policy rules that you want to accomplish, and only include in the quantitative model, for instance, critical infrastructure and vulnerable homes, or only include power utilities. There's a lot of flexibility here that policymakers have and need to take care of when trying to come up with the most efficient financial strategy. So that's the last step, like selecting the relevant segments of the loss exceedance curve that needs to be protected. What is the risk tolerance? As a local government or a local policymaker, can you live with more frequent events that will happen maybe every 10 years, 20 years? I mean, I drew these lines arbitrarily, please. Many of you may think they're quite high, and they probably are. But it depends on the risk tolerance of the governments and their financial position to see. There's always a trade-off between what the government retains and what the government transfers to the financial markets. So I hope this step-by-step mini guide was helpful. Now I would like to just get a little deeper on a practical case, and I chose Jamaica and tropical cyclone to talk to you about today. So as you know, the Caribbean country They have most of their exposures are concentrated in coastal cities. I've taken all this information is public. I've taken some measures of their loss exceedance curve that I found online, which is the little table down below. There you can see the return periods that I was talking about in terms of losses. So on average, every year in Jamaica, they would expect to see $67 million. I'm on the first row. $67 million of total direct damage, 300 million of direct and indirect costs just from hurricane. And then if you add on floods and hurricanes, that would increase the total damages will go to 223 and so on. So you have these measures of how much would we expect to see in terms of losses, economic losses, every 10 years, every 50 years, every 100 years. So the policymakers' problem or responsibility is, okay, how do we fund these losses? As you can see, events that go beyond 50 years are in the order of billions of dollars for Jamaica. So what did they do? They've been working for many years on establishing a comprehensive disaster risk financing strategy. You can see a little bit blurry on the right hand side, but what they've done is they've built on this scheme of high frequency, low severity, low frequency, high severity measures, and they've built on budgetary instruments. They have a contingency fund of 30-something million. This might be there might be some updates as new governments and new administrations come in and the budgetary process changes, but they've roughly separated 30 million for a reserve fund. And then obviously they have rules for reallocation in case of emergency. They also have a long-term budget for building better and investing in infrastructure. Then they do have some contingent emergency response components for financing. Most of these are provided by multilaterals. And then on top of that, they have contingent loans. They have a parametric contingent credit facility. They have, and then they have the post-crisis financing, which is IMF loans that can be used to stabilize the country in the aftermath of a severe event. And then they have sovereign risk transfers. They have a parametric insurance with a pool of an insurance pool that has been working in the Caribbean countries and Central America since 2007. And I will tell you what parametric means in a minute. And they also issued a bond into the capital markets where the principal of that bond is exposed. It works as an insurance cover, and the country gets to keep that principal in case a tropical cyclone happens with certain characteristics. And obviously they are enforcing that public assets purchase proper insurance. So you can see here that there's a huge mix of things that they are doing. And they've been able to do this because there's a range of quantitative models for Jamaica that have been developed privately and publicly that has helped policymakers come to the conclusion that they need this sort of multi-layer approach into risk financing. If we zoom in a little bit on the two market risk transfer instruments, and I will not bore you with all the details. I just wanted to show you that once you zoom into these things, there's some complexity, but they can be quite useful at the end. So what the CRIF, the parametric pool, insurance pool, offers to their members is an insurance policy that pays if an event, it can be a tropical cyclone or an earthquake or excessive rain, exceeds certain thresholds. That's called the attachment point. And that attachment point is generally established in a way that countries know that they will get a payout for events that happen, the loss events that happen every once in 5 or maybe 20 years. They can set that time period as the criteria to receive the money. Then they have an exhaustion point, which is, any event higher than this will be unprotected. Events that are really, really extremely low probability, high severity, there's a limit to what the insurance policy can provide. And then they get to choose, depends on the budget, how much, what slice of that insurance cover they would like to purchase or they can afford to purchase, which is the light blue area there. I know that everyone's going to receive this presentation, so I hope that if you have any questions, you can reach out later on, and I'm happy to explain a little bit more on how this works. This is a 1-year contract, but it's interesting that on top of that, Jamaica has gone into a 3-year cat bond program with the World Bank, where the Jamaican government is pretty much purchasing an insurance policy from the World Bank, being funded by the first version of this, which actually matured earlier this year, was funded, the premiums were funded by international aid agencies. And so they have a 3-year contract in that they're paying premiums to the World Bank, and the World Bank then issues bonds into the capital markets, and investors are at risk for these bonds. They provide the principal of those bonds goes to the World Bank and stays there and is ready to be deployed in case of a tropical cyclone that is eligible for triggering. And in the meantime, the investors receive the insurance premiums are as the bond coupon, as the return. So basically, you can see there some of the details of the transaction. And what's interesting is, how is Jamaica using the bonds and the insurance? The insurance might be in a lower, and we don't have the details; they're not public, but the insurance policy may be being used for lower frequency, lower severity events, and then the cat bond for maybe higher severity, lower frequency events. But then there might be some overlap between them. In any case, overlap is not bad. If we come back to my example here, in this example, it would be wise to use a combination of debt and insurance for the same return period in many cases. So maybe that's what Jamaica is doing. And this is because the sheer size of the potential losses exceed completely I mean, this is not fully protected, right? So anything that the government is doing to have quick money, as much as it can afford, it seems to be reasonable. Before going to questions, I just have a final remark. As for any policymaker establishing the correct financing strategies, we all have to be aware of basis risk. And basis risk is a very interesting concept in our field, because it builds up from the quantitative models. It is any residual unexplained reality from the hazard model or the exposure model or the vulnerability model. It builds up into what can happen with the strategy, which I'm going to explain in a minute. But it's also much more relevant for financial instruments, especially those risk transfer instruments where policymakers or governments are expecting a payout when something happens, right? So basis risk is basically the false negatives and false positives in the following in the following situation. So if you ask the question, did the financial instrument pay? No and yes. Versus, was the economic loss significant? What the economic or social loss significant? And it was observed, no and yes. Well, what you would like from your financial strategy or a particular instrument to do is that if there was no loss, there was no payment. And if there was a loss, there was a payment. So you have in the light green, you're in the light green boxes. And you want to avoid payouts that happen when nothing happened out there. That's a false positive. Or payouts that it didn't happen when something really bad happened. That's a false negative. So there's two things about building models in this way, quantitative models, and using them as a basis of financial contracts. And that is that obviously, in a financial contract, there's a counterparty, an insurance company versus the insured, and you want this situation to be symmetrical. You don't want anybody having a higher probability of landing in the blue boxes. And the second thing that you want to verify is that the blue boxes are minimal. Basis risk is a reality, it can never be erased, but it can be minimized. And quantitative models allow to understand it really well, and to actually include those criteria in the design and purchasing of financial instruments. Well, thank you. I'm not sure how we're doing in time, but this is everything I wanted to talk to you about today.
Thank you very much. Yes, it's 4 o'clock. So it's basically the end of the webinar, but we have just a few questions. So maybe the first one is, are investments done to prevent the effects of climate change considered as risk management strategies? I don't know who wants to take this.
Probably Ruiz.
So Laura, can you repeat the question, please?
It's in the Q&A. So are investments done to limitate or prevent the effects of climate change considered as risk management strategies?
Well, I think that's certainly the case. No, anything that is, climate change, what it's expected to do, at least for some or certain assets, is increase the frequency and or severity, depending on the asset and geographical location of certain events. So therefore increasing risk, or at least the tails of the distributions that we saw. So anything that is done. So here we are talking more about shorter term strategies, no, like risk financing, availability of funds if an event happens. Regarding climate change, we are talking more about things that in the long term will help us, or over a longer period of time will help us, like mitigate increasing risk that would be caused by climate change. So I would say that certainly anything that is done to address that can be considered as a risk management strategy. Yes, in my view.
Thank you. And yeah, the second one is, are both economic and social costs taken into consideration when designing a financial risk management strategy?
Oh. Dario, you want to go ahead?
Yeah, no, very quickly. Yes, absolutely. Policymakers need to make sure what the mandate is, and the mandate can be explicit, can be set in rules, in local rules and regulations, or can be implicit, the political pressures, or even just the responsibility that they want to bring on themselves and their government if something happens. So absolutely, social costs need to be are something that is considered.
Okay, thank you very much. Yeah, we don't have any other questions. So yeah, we have a message in the chat about a feedback survey that we usually send to all participants. We can fill it now, or we will also send it out by email together with the link to the recording of this webinar. So please answer the survey. And I thank you very much, the speakers of today, for their interesting presentation, and also all the participants who joined us today. And yeah, I remind you that the recording will be available probably next week online. Thank you.
Thank you very much.
Thank you.
Thank you, Dario.
Bye.